Hi, friends. Greg here. So, welcome to another edition of Your Question Friday, where I attempt to answer your money questions. We're going to talk about Warren Buffett's portfolio, what Warren Buffett thinks a portfolio for normal people should be. We'll talk about his $300 billion cash pile and whether that's cause for concern with the way that we invest. And more broadly, we're going to talk about the economic outlook that he has and what it means, if anything, for how we think about our investments. So, first, let me read the full question, which, if you ever have a question, you can submit it in the Google form in the video description below. Hello, Greg. My name is Foss. I'm a fan of yours from the UK. I think that's pretty awesome. When I first started YouTube like 8 or 9 months ago, I wouldn't imagine that I would be able to have the opportunity to talk to people from around the world about money. So I'm glad that the channel's having some reach and hopefully being helpful. That's pretty cool. So TLDR, what's your take on Warren Buffett selling stocks and holding cash? Does it signal a real market trouble or just noise despite rate cuts and a weak dollar? My question relates to some videos I've been watching with regards to Warren Buffett selling a lot of stock and sitting on cash. Now, I fully admit I may have just watched too many videos recently, and with the algorithm being what it is, these larger accounts do like to attract attention with scary headlines. I always have to laugh at that because I see, as I'm looking at money content, there's all these people like holding their faces and like acting shocked about stuff, and it's all very cheesy. I have a hard time even participating in this space. It's all kind of a little silly. So I understand what you mean with the algorithm. But I wanted to ask you, what are your thoughts in terms of what the situation looks like from your perspective? On the plus side for stocks, it does appear the price of the dollar is low, interest rates are due to be cut further, and as a result, we should see renewed growth and more all-time highs. I know it's impossible to predict the market, but I just want to get a general sentiment of where you feel we are at the moment. If you're get around to answering this, thank you. Have a nice weekend. Awesome. So to answer this question, there are so many moving parts, and I think what happens for most people is we all kind of talk past different parts of what Warren Buffett's talking about. And so I've actually put together a presentation called Warren Buffett's Point of View, which is kind of a decoder for me to make sense of things. I have a background in corporate strategy and nerding out making presentations. I used to make presentations to a Fortune 100 board of directors. So that was my responsibility. And so anytime I have the opportunity to make a presentation, I think I naturally gravitate to that. So that's what I'm going to walk you through here. Okay, so this is my decoder ring for Warren Buffett when it comes to worrying about the future and just the general state of things. So you may be a normal human over here like me. I often think about this gif on a daily basis. You read the news or you read a worrying headline and you're like, "What do I do?" Well, the first thing to understand is that Warren Buffett, down here in the orange business section, is fundamentally a business person. So his point of view when he's giving wisdom or feedback, it's to these different groups, and it's all connected to what the impact to long-term business success is. So as an example, the way you invest in a business. You could do value investing or passive investing, and there's tons of other ways to invest. But Warren Buffett is a value investor, and we'll get into what that means later. But he encourages people to do passive index fund investing, and we'll get into why. So that's part of the conversation. But then his other concern is around what's happening in the government, and I'll get into what country dynamics are later. But what he really thinks about is how different dynamics in a country impact business. And it's funny. I see some cheeky comments from people. They leave comments like, "Well, if Warren wasn't happy with the government, why doesn't he just create government policy?" The answer to that is he's in this orange box. He's a business person. He's an investor. He's an expert at what he does. And what he's doing when he shares feedback about anything is he's saying, you person in the government that should be an expert in creating government policy or balancing the budget in the government, what we're worried about as a business is this, and you should go focus on that. So it's not really his role to be both the business and the government. He's squarely in this box. So before we get into what he's worried about and talk about what that might mean for you, let's talk a little bit about how he thinks about investing, which is this section over here in the bottom right corner. Okay, so the fundamental thing that we need understand when we talk about Warren Buffett's perspective on investing. Remember, that's different from the economy, it's different from government, it's different from fiscal policy. And that is, and I think in Warren's worldview, there's really two types of investing. There's passive index fund investing, and then there's value investing. And so let's get into what the differences are. And that subtle difference is what's going to help us understand the $300 billion cash pile he has, what that means for you as an investor. So the first thing I want to call out are these two quotes at the top. And so this entire presentation will be quotes from Warren Buffett in these different decodering sections that I've laid out. So the first thing when we think about investing, and I think this is really important, is that no one can, I will just read his quote, no one can tell you when these traumas will occur. Not me, Warren Buffett, not Charlie Munger, who was his partner who passed away, not economists, and not the media, and certainly not me as the money monk. um, and this is a really hard thing to accept. One of the hardest things as a more advanced investor is this feeling that like you're standing in front of a freight train that's about to run you over and you're just going to stand there. So the default behavior for most humans is like get out of the train tracks, where really more advanced investors, it sounds really simple and it doesn't sound smart, but a lot of times you just have to stand there. You have to stand there and expose yourself to risk. So the second quote is, when the scary period does eventually come, investors need to remember that widespread fear is your friend as an investor because it serves up bargain purchases. So why is that? That's because when there's widespread fear, everybody's freaking out, everybody's selling their stocks. They want to exchange their stocks because they are scared of them. They don't see businesses as valuable anymore, and they want to get what money they can back. They feel more secure with cash. So they start selling their shares in businesses. What that does is it decreases the value of companies. And so what he's saying is that when everybody's fearful, there's bargains out there to be able to purchase businesses that are undervalued. And that, yeah, and then he talks about, personal fear is your enemy. And that's really where jumping out of the train tracks, so to speak, is counterintuitive, but that's going to cause you to either buy at highs when you're scared of missing out on investments, and it will have you sell at inopportune times, like right at the bottom. So that's kind of the fundamental behavior that you need to understand, whether you're a value investor or you're a passive index fund investor. But let's go through what these two things are. So Warren Buffett is a value investor. So let me give you a few definitions here of what I think about when we talk about value investing. So a value investor, they're looking for businesses that are priced incorrectly. So the market's looking at businesses, and like in my last video I talked about, there's like 70 million different trades a day. So the entire market is looking at all businesses in the stock market, and they're trying to come up with a fair value for each individual business and stock. And a value investor is saying like that business is priced incorrectly for some reason. So they're looking for a bargain. And to do that, they're looking at companies with unique opportunities in their sector, unique business characteristics, attractive fundamentals. And so the third thing I want to call out here is that they hold cash as needed and they strategically pick businesses. Now, maybe not all value investors do this, but I'll call this out for Warren Buffett to answer the question about the $300 billion cash pile. So what he's looking at are, where are the bargain opportunities? Where can I extract the most value by putting money into a company that I believe has, unique characteristics? And importantly, if a lot of businesses are overvalued as he would assess, then it's not a good deal. Then he'd rather, sit in cash and wait to find businesses that they could strategically pick up. One of the things I want to call out in this fourth quote, this is a quote from Warren Buffett. I love this quote. He says, every decade or so, dark clouds will fill the economic skies and they'll briefly rain gold. So what's interesting here is you start to understand the difference in mindset of a more advanced investor is when scary stuff's happening. So you see these dark skies in the economy. What he's looking at are, oh my God, all of these companies are going to get really cheap and I'm going to be able to put my money into them and I'm going to be able to return a lot of money. So what most people are scared of is like the downturn. He's waiting for it and he's excited for it because that just means he'll be able to invest in businesses that he thinks are highly valuable that are cheap. So, what's really important to understand here and where people talk past each other is you have to decide if you are going to be a value investor or a more passive index fund investor. And I'm going to get into what passive index fund investing is. But what you don't want to do is look at Warren Buffett holding $300 billion dollars in cash as a passive index fund investor and modify this strategy over here on the right because of something that a value investor is doing. Neither one is good or bad, and I'm actually going to walk through long-term performance of each of these so that you can kind of see that. But it would be confusing strategies. Okay. So that's a value investor. So let's talk about what passive investing is. And so Warren Buffett's portfolio, he's famed for saying you should invest 90% of your money in the S&P 500, which are the top 500 largest companies in America, and then 10% in like short-term bonds or cash. So let's talk about his view on passive investing. So one thing that I like to call out is Warren Buffett, when he passes away, what he is leaving his wife is this investment over here. He's not trying to leave her something around like, value investing and leaving his wife with having to pick out stocks or anything like that. So he follows his own advice. What he's saying is, what I'm leaving my wife is 90% in an S&P 500 and 10% in short-term government bonds. So why does Warren Buffett leave this to his wife? Why is he a big advocate for passive investing? So what he says is the typical investor doesn't need the skill of value investing. And the reason why is because in aggregate, American businesses have done wonderfully over time and they're going to continue to do so. And we're going to get into why he thinks that in a following slide as we get into country dynamics and what it means for business in whole. The other important part is an investor doesn't need a fund manager or the fees that come with fund managers. The important thing to note is that fund managers do not beat the S&P 500 over the long term on average. So if you have a wealth advisor or you're paying a 1% fee to someone to actively manage your money, really that's going to be a losing strategy to passive investing overall, or at least that's what Warren Buffett believes, and that's what has been shown to be true, study after study after study. The more active you are in the stock market, the more poorly you do. Okay, so through a few other quotes on passive index fund investing. I love this. So, he says, "My friends with more modest means, I tell them just invest in passive index funds, and yet." None of his super rich people or pension funds do the same thing when he gives this advice. And I love why he says this, and I want to talk about this for a minute. So, why do the wealthy reject this advice? One is that he says professional consultants would be committing career suicide if they told their high net worth clients year after year to keep adding to an index fund replicating the S&P 500. So, why is this? Well, it's because these professional consultants and wealth advisors and all of this, they make their money off of fees and they have to sell the idea that they add value in this process. So if someone came to you and said, "Look, I want 1% of your wealth every single year and all I'm going to do is buy an S&P 500 index fund for you." You might ask the question, "Well, why do I need you?" Well, so there's all, all of these consultants, they have to act as though they're adding value to the system. When in fact, really, they're not. Now, I'm not saying don't have a financial advisor. They do have value. I would say I think a financial advisor helps more with planning and it helps much more with bad emotional decision making. I think a good financial advisor is probably worth their weight in gold, but it's more because they're helping you not make emotional errors in the stock market, not because of their ability to pick a stock or an index fund. So one is, and I saw this in the corporate world. It's funny because it's like, if you got a budget given to you in a year, you couldn't just return the money because you're not going to be able to say as an executive, "Well, I don't need all of this money. I don't have anything good to do with it." The career suicide is everybody has to pretend as though they are making something out of whatever they're given. And so everybody kind of plays along with this idea that they're adding value because they have to. They have to show that they're adding value. The next thing, and I love this, is The wealthy think their money should buy them something superior compared to what the masses receive. And if you've been around super wealthy people, it's like there's this ego is that they deserve something different. They deserve something special. And and so it's funny because there's plenty of companies that are more than happy to cater to the need to feel special because they get paid a lot. And so this is where you get into private equity and all these fancy securities and all this other fancy stuff that you pay more in actively managed fees, and you end up underperforming what could be a very simple thing, which is just investing in the stock market passively. And so now what we'll do is we'll look at value investing and passive index fund investing and look at how they've performed over time, and then you can kind of decide what you want to do. So the first thing to note is Warren Buffett's portfolio for passive index fund investors is buying 90% of your money going into the S&P 500, and then 10% going into some cash-like fund. So what I've done is I've constructed his portfolio. VOO, I'll type it here. What you can see is Vanguard 500 Index Fund ETF share. Berkshire Hathaway A-class shares is basically just buying into Warren Buffett's strategy. So what I would say is, let's say you wanted to be a value investor and you just wanted to give your money to Warren Buffett, who is like one of the best value investors of all time. You could go try to be a value investor on your own, but there's no end to the amount of YouTube gurus that are telling you what stocks to pick. I think that's all kind of silly and a waste of time. But if you're going to have somebody pick a stock, I would I would rather give my money to Warren Buffett and have him do it. And so what we want to see is what is the difference between the S&P 500 and a value investor like Warren Buffett. And so I'll also go through a few other portfolios here. So 100% Berkshire Hathaway or 100% S&P 500. And then lastly, a view of a 60-40 fund. And so 60-40 means your 60% of your money is in the S&P 500 and 40% is in a fixed security like bond. And so what we will look at is what has the performance been over the last 15 years for these different types of portfolios. So what you can see is that the winner is the S&P 500. So if you were 100% invested in the S&P 500 from 2010 all the way to 2025, you end with $80,000. Let's say you went with Warren Buffett's S&P 500 cash mix, you end with $67,000. If you went with Berkshire Hathaway and a 10% cash holding, you end up with $52,000. But the point is that the real success story and the focus, at least in my opinion, and what I've been focused on personally, is that what you can't afford to do is be in cash. You can't afford to not be invested. And whether you are more risk averse, and so you put 40% of your money in bonds and 60% in stocks, whether you think the S&P 500 is overvalued and you're scared of that, you're successful as long as you're consistent. And so, if you fundamentally don't like the idea of just putting your money in every single company in the United States, and you like the idea of value investing, then invest in Berkshire Hathaway. But what Warren Buffett's approach has been is, heavy in equity and a little bit of cash on the side. And that's done very well over time. The important thing to note on the $300 billion cash on the side question is that is for Warren Buffett's value investing strategy. And so nowhere in his recommendations has he said, sell your US equities where he recommends 90% and go, 40% in cash, for instance. And so I think what gets confused oftentimes is the way he is allocating money for his value investing strategy is different than the way he would recommend you invest for passive index fund investing, which is staying 90% in equities, 10% in cash, and staying the course. Okay, so what Warren Buffett advises is you don't change your cash holding based on what's happening in the world. I thought one of the interesting things would be to play from his latest annual meeting a bit about volatility, because and that's really the large fluctuations in the stock market and his take on recent volatility. And I'll just play that here.
If it makes a difference to you whether your stocks are down 15% or not, you 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 need to get a somewhat different investment philosophy, because the world is not going to adapt to you. You're going to have to adapt to the world, and you will see a period in the next, certainly in the next 20 years, you'll see a period that will be in what somebody in the market described one time as a hair curler compared to anything you've seen before. I mean, it just happens periodically. The world makes big mistakes, and surprises happen in dramatic ways, and the more sophisticated the system gets, the more the surprises can be out of right field. That's part of the stock market, and that's what makes it a good place to focus your efforts if you've got the proper temperament for it, and a terrible place to get involved if you get frightened by markets that decline and get excited when stock markets go up. I don't mean to sound particularly critical. I mean, I know people have emotions, but you got to check them at the door.
So that's a great excerpt of, how to think about investing. You separate your asset allocation and your emotions, and you stay consistent over time. And so I think that's Warren's feedback, is that there's going to be something big that happens one day. We don't know when it's going to come, but that these complex systems that we're in, they break in surprising ways, and they break in ways that we can't predict. Now, I think one thing that's interesting is, what is Warren Buffett worried about? So, Warren Buffett talks about a lot of different things. And so we're going to get into some of the quotes that I pulled out that I thought were helpful. And what I've done is I've color coded these quotes at the bottom. Orange is kind of his business lens on things. This blue is a country perspective, particularly for the United States, because that's what he talks about the most. This other kind of teal color is more about the people, and then purple is for government. So let's get into taxes a little bit. So I love this quote from Warren Buffett in his annual letter. He talks about the fact that Berkshire Hathaway as a company has paid over $100 billion in taxes, and in 2024 alone paid $24 billion. And so what does he say? He says, "Thank you, Uncle Sam. Someday your nieces and nephews at Berkshire hope to send you even larger payments than we did in 2024. And I highlighted this in purple because this is where he starts talking about the government side of things. He said, "Spend it wisely. Take care of the many people who, for no fault of their own, get the short straws in life. They deserve better." I love this quote because I think it points to the fact of, like, what is government's role, and then he talks about monetary policy. Never forget that you need to maintain a stable currency, and that result requires both wisdom and vigilance on your part. So here he is as a business person, going back to the first slide. He's looking at, what makes successful, businesses over the long term inside of a country. And he's kind of focused on, one, taking care of the people in the country, and having good monetary policy. So why is he so focused on monetary policy? So let's go to the second quote. He says, as Berkshire Hathaway, their shareholders can rest assured that they will always prioritize putting money into companies, and that they will never prefer cash equivalent assets, which are just things sitting in cash. Now, going back to the investing that we talked about, the reason he has so much money in cash is so that he's waiting to basically be able to invest in other businesses. It's not the preference that things are sitting in cash. It's in preparation for buying something else. The next part he calls out is, paper money can see its value evaporate if fiscal folly prevails. Okay, so the next part we need to understand are, what are Warren Buffett's country dynamics? Like, how does he look at the world? And to answer that, I thought this quote is really important to understand. So he prefers American businesses and equities. The four things that he says are unique to American businesses are the ability to innovate, the productivity that American businesses have, the entrepreneurial spirit in America, and an abundance of capital. Whether you are a value investor investing in Berkshire Hathaway, or you are investing in the S&P 500, which he talks about as a passive index fund investor, These are kind of the underpinnings for why he thinks that will be a successful long-term venture. I think the important thing to understand is in this next quote. So he says, businesses as well as individual people will find a way to cope with whatever monetary instability, which is government decisions, as long as you can create goods or services or value that are desired by people. And so this is another reason why it's important to not sit in cash, is because you're owning an asset that's creating something of value that people want. And that for a very long time has been a way to stand up to bad monetary policy regardless of the country that you're in. Okay, finally, I just want to round out his worldview. So for him, what he says is that really the deployment of savings by citizens, so people like you and I, are putting our money into businesses that create goods or services, and that this is really the most effective way for people and governments to thrive. And that's what he calls capitalism. So this is where you get into this light blue, where we're talking about the systems that a country has in place for business and really prosperity. So this is where he also says, Charlie and I, as business people, so the orange, would not have achieved our results in any locale except America. And why is that? It's because of what he attributes to a thriving business environment. This next slide is really like, what is Warren Buffett concerned about? Because that's the second part of the question is, apart from the cash, what's going to happen? So here are Warren Buffett's concerns based on his shareholder letter and interviews that he did in May of this year. So there's 5. So he talks about runaway inflation and currency debasement. I'll summarize some of this in my own words, but he talks about the fear that if you have a government that's running a 7% gap or more between the revenue that it collects through taxes and what it spends in expenses, that leads to, or could lead to, runaway inflation that can get out of control and you can't do anything about it. He talks about, increases in government spending, even in 2025, while also decreasing taxes. And he talks about a decline in global trade and country relationships. So, a few quotes here. So, the big thing that we worry about with the United States currency is the tendency of a government to want to debase its currency over time. There's no system that beats that. Devaluation of currency is a scary thing. So, the challenge here is if the underpinning currency that drives everything becomes less and less worthwhile, there's nothing that you can really do about that. And he has other articles where he's currently talking about being invested in the yen and different currencies, and he's also talking about diversifying Berkshire holdings outside of the United States, which I think is an interesting departure from what we just saw in the previous slide, where he talks a lot about America being this place that is unique from a capitalistic perspective and creating businesses. So let's talk about the next thing. So he says fiscal policy is what scares me in the United States. All the motivations are to do things that could cause a lot of trouble. The other thing he talks about is trade. So he talks about the latest trade wars. He says trade should not be a weapon. There's no question that trade can be an act of war, and I think it's led to bad things. Just look at the attitudes it stirred up in the United States. The next part he says is it's a big mistake, in my view, when you have 7.5 billion people, so the world, that don't like you very well, meaning the United States, and you have 300 million people inside the United States that are crowing in some way about how well they've done. I don't think it's right, and I don't think it's wise. So what he's really talking about in this last quote is, if you are losing international goodwill and now businesses are not as effective at being able to trade and make a profit because now you have this protectionism going on, that over the long term, a mix of bad monetary policy where you have runaway inflation or currency debasement, you have a government that is unable, to say it that way, to balance the revenues that they have coming in with the expenses that they spend. There doesn't seem to be an appetite in raising taxes. Warren talks a lot about the amount of tax that they pay into the system and asking the government to make use of that by helping people, mixed with protectionism and trade used as a weapon, that ultimately that all spells problems as a business person. So the question is, with Warren Buffett's concerns, what do you as an individual investor do? I think his advice about being 90% invested in companies, 10% in some type of cash holdings is, a good idea. I think it's important to be invested in some type of asset. The risk is you're sitting in a currency like the US dollar that might be declining, and you're not holding assets that is able to keep up with inflation. And so I think an important thing to think about is, are companies getting more valuable over time, or is the dollar just getting weaker and weaker and it's taking more dollars to buy the same amount of value in the market? So the risk is that if you get out of the market, whether it's the US market or an international fund, those things are just going to get more and more expensive as the dollar gets less and less valuable. As Warren points out, he's less concerned about the stock market fluctuations over time, so the up 15% or down 15%. What he's more concerned about is the currency that underpins everything, and what regulators are doing around that. But I think probably the worst option would be to worry too much about stock market fluctuations, get out of an investment that has the chance of holding up to inflation, and then sitting in a currency that might be getting worth less and less. And then I think the other thing is Warren's point about not knowing the future, and really calling out the fact that something's going to happen in the next 20 years. Nobody knows when it's going to happen or what it's going to be. He says something that comes out of right field. With complex systems, it's really impossible for anybody to predict. And if you're worried about the United States in particular, which he calls out, what you could consider is diversifying internationally. So for me, I invest 20% of my money in an international fund. So I'm not fully exposed to the US stock market, although mostly I am. Um, if you've been 100% in the US stock market for the last 10 to 20 years, you have outperformed people that have invested in the rest of the world. There's decades and periods where the rest of the world has performed better than the United States. The idea behind diversification is that you are always going to have a loser. There's going to be some part of your investment portfolio that's not doing well, and then there's going to be another part that is doing well. The idea is that you're not putting all of your eggs in one basket. And so for me, that's why I put about 20% of my money in the rest of the world. And the other thing I focus on is what Warren Buffett talks about, is that cash is a terrible investment. I wouldn't get distracted by the $300 billion in cash that he holds, because that's really part of that value investing strategy that he has. The main thing I'm focused on is investing as often as I can and being diversified. So that's my world according to Warren Buffett, based on the things that I've looked at. And so I hope this has been helpful in some way to you. I think the key thing is that you separate out, investing strategy and policy with economics and what's happening over there. And ultimately, then also pulling out the human emotion from your investing behavior, and then picking an investing strategy and sticking to it. The worst thing that you can do, in my opinion, is, changing and being really active in the stock market. So if you're allowing your emotion to rule you, you're scared at here, and then you're investing when you're excited. That's kind of the recipe for making bad decisions. So I hope that helps. And if you have any questions, feel free to leave them in the comments, and I look forward to talking to you next week.